Hi, welcome to West Coast Stackers. The economy continues to be in the news, but what does that mean for our silver stackers? Possibly recession and continued inflation are never a good sign for stacking silver. Traditionally, uncertain economic times tend to awaken people to precious metals. More people stacking silver means higher silver prices, right? This week, Jerome Powell, the Fed chairman, has revised the possibility of seeing a recession later this year. And the media suggests that inflation seems to be coming under control. It reminds me of the time when my wife took care of a couple little boys, and they were 17 months or 3 years. When they fell and got startled, she would rush to comfort them and say, "Oh, you poor baby," and they would cry and they'd see comfort in her arms. But one day she came up with a brilliant idea. After their fall, she began saying, "You're fine, you're fine, you're fine, you're okay, you're okay, you're okay, walk it off, walk it off." And to her surprise, at first they looked a little bit confused and they were unsure what just happened. They stopped crying and they tentatively resumed playing, but by their appearance, they knew something wasn't quite right. And she continued acting like nothing happened, and with a little confusion and a few sniffles, they began to play, and they forgot about their little mishap. Today, the media assures us inflation is down, yet we know we're still spending more on gas and food. Even some analysts have revised their predictions on the possibility of recession. We're told by our friends in the media the economy is doing great. The Biden administration just hasn't communicated how well the economy is really doing, and that it's just all a matter of perception. You know, I feel like the two boys that my wife took care of, and over the past 3 years, we've taken our little economic tumbles. Inflation has been munching on our savings, but the government and the media are telling us, "You're fine, you're fine, you're fine, you're okay, you're okay, you're okay." But unlike those two little boys, I know something's up. Hang tight, and we'll be right back. We'll sketch out our situation and explain a little bit about the economic pickle the U.S. government finds itself in. Welcome back. The media has been telling us that the economy is good, and us, the American public, we just don't know it. I own a small business in Southern California focusing on same-day deliveries. We deliver commercial electronics, aircraft parts, medical instruments, occasional human organs. But in July, our business is down over 50%. And yet, our fuel costs still remain elevated, over 155% in the last 3 years. Economists generally look at manufacturing slowdowns as a prime economic indicator. But for us in the courier business, logistics, we tend to see them secondarily. The manufacturing slowdown, and then we tend to see some slowdowns ourselves, of course, right? I had a call yesterday from a friend from another company asking if we were slow, and I told them, drivers have been checking in with us from other companies, seeing if they could pick up extra work. And it tends to be slow across a lot of these different logistic and courier companies. Let's take a look at what Jerome Powell, the chairman of the Federal Reserve, said about the economy this past week.
That happened. So the staff now has a noticeable slowdown in growth starting later this year in the forecast, but given the resilience of the economy recently, they are no longer forecasting a recession.
It is such a relief that the Fed chairman and those creating the report had said it's unlikely that we'll face recession. But let's take a quick look at this Chuck Todd segment on how the public perceives the economy right now.
So, why do people feel bad about the economy? It has to do with overall confidence about where they think the economy is going. So consumer confidence down a bit from March to April. But here's why. Consumer confidence went up from March to April sort of in the moment. People said, yeah, the economy is good right now. In fact, better this month than it was last month. But then you ask them, what's it going to look like in 6 months? And they still believe we are headed to a recession. Now, people have believed this now for over a year, and a recession hasn't come. So pessimism in many ways is what's making people think this is a bad economy.
Many times, financial analysts, after they listen to the Fed chairman, they will carefully parse each word and phrase. So if you allow me, let me take a stab at trying to decipher what the Fed chairman said. You're fine, you're fine, you're fine, you're okay, you're okay, you're okay. You know, my largest expense, fuel, is still elevated and is not coming down. Maintenance costs have increased. Interest rates on purchases when I need to replace vehicles is up. The largest logistics company we subcontract for has been laying people off. But you're okay, you're okay, you're okay. Walk it off, walk it off, walk it off. And here's something I realized when watching figures like Fed Chair Jerome Powell. Because of the politics surrounding their job and their personal influence in that role, they simply can't say recession is coming. If the Fed chair were to say, we're going to face recession in a couple of months or a year, stocks would crash, sales would plunge, the economy would tank just on his word alone. When Fitch Ratings downgrades a credit rating, it's an assessment of the group's creditworthiness. In this case, Fitch Ratings downgraded the credit rating of the United States debt from the highest possible AAA rating to AA+. This downgrade suggests that Fitch perceives a slightly higher level of credit risk associated with the U.S. government's ability to meet its obligations. I already planned out this video prior to the big news. Let me continue to explain the economic pickle the U.S. financial system is in. In 2022, the national debt reached a staggering $32 trillion. In that same year, the United States gross revenues totaled $4.8 trillion, and they overspent $6.4 trillion that year. Looking back on my credit card predicament, my debt was only 2/3 of my earnings. The U.S. government debt to revenue ratio has skyrocketed to over 6 times earnings. You know, someone may say you can't compare personal finance to a state economy. A million things could happen in an economy. It could explode with growth. We can make drastic cuts, make fiscally strong policies. But does anybody really believe this administration could pull that off? In my analogy, I found myself caught in a situation where I could only manage the minimum payments on my debt. It was relatively prosperous times, but in this credit situation, the Federal Reserve faces a challenge in managing the U.S. debt, as they are currently raising interest rates on themselves. This increase in interest rates has a cascading effect, leading to higher costs for everyday purchases, for consumers such as appliances, homes, cars. You know, unfortunately, many individuals find themselves unable to afford these higher priced purchases due to the increased interest rates. And as a result, there's a slowdown in both buying and selling, causing the economy to decelerate. This economic downturn leads to job losses, which further compounds the slowdown. Now here's where the situation gets a little more complex. The Federal Reserve is essentially raising interest rates on themselves by increasing the rates on trillions of dollars worth of government bonds. This situation creates a paradox. There might come a point where they struggle to meet the interest payments on these massive bond amounts. In the context of inflation, it's important to understand its stickiness. Once it takes hold, it becomes difficult to eradicate. An illustrative example of this is in the 1970s, a decade characterized by persistent inflation. To combat this, Paul Volcker, the Fed chairman at the time, took a bold step and raised interest rates to an astounding 20%, but the U.S. only had 30% debt. This move aimed to curb inflation permanently, but simultaneously under Reaganomics, the economy underwent deregulation, leading to a concurrent economic boom. This is the economic pickle currently facing the U.S. Inflation has risen. There's a delicate balance to strike with interest rates. If they raise them too aggressively, it could potentially lead to a slowdown in economic activity, a slowdown of buying and selling and recession. If inflation remains unresponsive, the room to raise interest rates becomes limited, and the risk of the U.S. debt becoming unsustainable looms where the ability to meet creditor obligations could be compromised. Inflation is down for now. Hopefully it stays down. Are we in the eye of the hurricane where there's relative calm before the next destructive economic storm strikes? Higher inflations? Recession? I don't know. Getting a clear picture from the media is difficult. Like the Chuck Todd segment in the political news, we find out how the consumer feels about the economy. The questions we will continue to see is inflation or recession coming? I really can't predict. But next video, we're going to explore the most reliable indicators for recession, and we'll see where they are pointing. Thank you so much for being part of West Coast Stackers. If you received any value from this video, like, share, subscribe. Help us to continue to bring you increasingly better content. Remember, stacking silver is a fundamental right we must protect. Look behind the curtain, question the world, stay vigilant, and remember, keep stacking.